Hello, everyone. This is Mohammad Akif with Akif CPA. And today we'll be talking about a tax guide, an ultimate tax guide for Canadians who are moving to the United States. This is very important because a lot of Canadians, when they are moving or they have moved, they have no idea. And then they're waking up to a lot of the reporting and tax issues when it comes to file. So I want to make this video for Canadians who are fellow Canadians who are moving or who have moved, and this is your first year of filing in the US, to understand how things will work for you to make sure that you plan ahead, for you to make sure if you have missed the deadline or missed the planning, you take actions which can simplify and make it easy for you to file on both sides. It's very important because we don't want to be stuck on both sides. We don't want the filings to continue. It does cost money. It does cost tax. And then so the whole point of you moving starts to weigh heavy. And we don't want that, right? We want things to be simplified. We want things to be manageable. But especially when it comes to cross-border taxes. These are two different countries, two different systems, and then two different tax ways. So I want to make sure that you understand how things are going to be on the Canadian side, how things are going to be on the US side, what reporting forms are required, and then what can you do to minimize reporting, to simplify your reporting, and then where it can be manageable, right? So let's dig into it. I'm going to share my screen with you. By the way, we do have a lot more videos on this topic. We have a lot of videos for Canadians who have moved to the United States or who are living in the United States and have tax issues. That includes your retirement plans, that includes your rental properties on the Canadian side, how the taxes work when you have rental properties, and then when you have retirement accounts, or you have jobs or businesses on both sides of the border. So we have multiple videos. You can check our YouTube channel. You can also check our blog on our website at akifcpa.com. And then, of course, if you have any questions, email us at info@akifcpa.com. Let's get started. All right, so there we go. So first, again, we'll go with in terms of why it's important, right? Because a lot of people move for many different reasons. People are moving for jobs, for businesses, for family reasons. And then a lot of people move to states where there are no state taxes or low state taxes than versus Canada or province they're coming from. So we want to make sure that, whatever the purpose is, that you are paying the minimum tax possible, right? We don't want the maximum tax, especially when you're moving to US for work or business purposes. We want the minimum tax. And for that, you have to understand how things will work. So this one-stop tax guide for Canadians moving to US is a one-stop shop where we talk about how things will be on the Canadian side when you move, how things will be on the US side when you move. That includes reporting forms. And then what can you do to simplify your reporting? Right, so this is the summary of what we were discussing today, and then there's a lot more. I'll try to cover as much as possible in this video, but there's a lot more. So if I don't cover any topic that is relevant to you, shoot us an email, info@akifcpa.com, and we can definitely help you. All right, so let's get started. So first of all, what happens when you actually move to US from Canada? So first thing that we want to look at is your Canadian tax residency. Are you still a Canadian tax resident? That's number one. Number two is that how the Canadian departure tax works. So if you are moving from Canada to the United States, of course CRA will tax you on certain assets that you own in Canada. So that means there will be a deemed disposition. We'll look into what deemed disposition really means. And then again, what happens to your Canadian assets, which includes your retirement accounts, your investments, your real estate, your shares. There's a lot more to it. And then we'll talk about how can you whole understand, tax in 5 simple steps for Canadians? I want to, touch on that topic first, and then we'll get into the illustration, which is number 6. And then we do have a checklist that we're putting out on our website that you can download. It's a text checklist, which lists down a lot of the items that you need to go through to understand how things will work for you. All right, so let's stop. Let's go to the 5 simple steps first, and then I'll get into other items. So 5 simple steps for Canadians moving to tax in 5 simple steps. So what do you really need to do, right? So step number 1. Step number 1 is to understand Canadian tax consequences on assets, investment, real estate, when you leave Canada. This is very important because this is how it starts. This is how it starts on the Canadian side, and this is how it starts on the US side. So make sure that you understand how the CRA will be taxing you on certain assets. That's step number 1. Next thing, once you do leave, how the US is going to tax you. That means how the IRS looks at your assets. And then what are the tax implications when you have those assets while you're living in the US, right? That's the second step. So understand, number 1, understand the Canadian side, understand the US side of the assets. So once you understand both sides, then you can determine, okay, I need to get rid of these Canadian assets first before I move. So whatever I'm going to do here on the Canadian side will impact the US side. So this is all in the part of making it simplified and manageable, right? That's step number 2. Step number 3 is once you do understand what you need to do, then again, find out about the reporting requirements in terms of what you need to file on the Canadian side, what forms you need to file on the Canadian side, and when you need to file those forms. Important. The due dates are different on both sides. There is an element of extension on the US side too, which we do need to make sure that we take advantage of. And then so, we're coming from the Canadian system. We understand, April 30th is the T1 deadline. And then, of course, we have the self-employment deadline for June 15. But, on the US side, the dates are different. And then we do have extension available. That extension is to extend the filing, but not the payment. This is just to be clear on that side. The extension is to file, not for the payment, for the tax payment. And number 4 step will be to find out what reporting requirements are, or what forms are there on the US side. So beside the 1040, what else do you need to file? FBAR, 8938, if you have PFIX, or do you have capital gains that needs to be reported. So these are all the things that you need to go through. Of course, tax treaty elections, that's number 1, right? Because we want to make sure that we do take advantage of the Canadian-US tax treaty. The benefits that come with the tax treaty, make sure we do take them. And a lot of accountants do miss them. I've seen many tax returns where US accountant and the Canadian accountants will miss those tax treaty elections. So reporting is the key here. And first year reporting is the most complex, right? So make sure we understand reporting forms on the Canadian side and reporting forms on the US side. And then again, finding out the differences between the timings, how the system works, what they're trying to tax you on, where reporting is required, so you can plan. Planning is the key here. So I've worked with a lot of Canadians who move and then don't do any planning. And next thing you know, they find out things next year. And then now we're trying to play catch up. We're trying to figure out how we can close certain accounts, what we can close investments, how the tax is going to look like on the US side, how the tax is going to look like on the Canadian side. Are we still Canadian resident? Are we still tied to Canada? If we're still tied to Canada, do we have to report the US income? There's so many questions running through your head. And then is Canada trying to tax me on the US income? Are they going to be a double taxation, right? See, these are things that, in some cases, yes, in some cases, no. There might be additional taxation because Canadian tax rate is higher than the US. So you get into all these scenarios, without even knowing it, right? We are excited to move, and of course, when we are moving, and it doesn't matter where we go, but these are important things that need to be planned out, especially when it comes to taxes. And then so I get a lot of stress out Canadians coming to us and then saying, hey, Mohammed, this is what happened. This is what happened. I didn't know this. I didn't know that, right? It's okay. We can work with things. We can plan things. And now we do have reporting requirements that need to be met. So these are things that need to be planned ahead. And then, so it is very important to understand the Canadian side, step number one, on all the investments, retirement accounts, real estate that you own, how the CRA is going to tax you. Number two will be to look at the US side, how the IRS is going to tax you, what reporting requirements are there, understand what filing requirements will be on the Canadian side. And number four will be to understand the US filing requirements, right? And then number five will be to understand the system, the due dates, the certain things, how the how the CRA looks at things, and then how the US side looks at things. So these are very important. 5 steps, 5 simple steps for Canadians who are moving to US, how to file your taxes, how to understand. Now let's get into the detail of this video. So we touched upon how this guide will help you in terms of simplify things. We touched upon what are steps that need to be taken. And now I'm just going to focus on the Canadian side, understanding how I'm going through the assets. I will be going through how the CRA looks at it, and then try to summarize all the assets on the Canadian side versus US side. And of course, we'll look at the chart too, which is an amazing chart that you can go through and plan. So let's talk about Canadian residency, right? So Canadian residency is important. It's very important when it comes to how the taxes will be. It's very important when it comes down to finding out, are you still a tax resident or not? Are you still tied to Canada or not? And then there are many different factors. We have primary ties, we have secondary ties, and primary ties can include your family, your job. Of course, you're moving, if you're job changing, or your investment. There are many things that go through. We have a test that goes on the Canadian side. So, once we go through the test, we determine that are you still tied to Canada or not. Remember, the test is very clear. And if there is an issue where you don't understand, are you tied or not, there's a form called NR73 form that you can fill out and send it to the CRA. And then let the CRA make the determination on your residency. So that form is available. That is the second option. We don't take that as a primary option. We'll take it as a secondary option. The first option is to go through your primary tie and secondary tie, see if you're still tied, right? So how do we do? Once we go through this, of course, we can see your social ties, your property, your family, your home, and then so when the ties get cut off, right? So again, the date that we look at is when you exit or when your family exits, right? This is very important too. In cases where you have exited and your family's still back home in Canada, you're still tied to Canada. This is one of the main ties. These are one of the primary ties. And then also when you really establish your residency in the US. So we do have certain things that need to be done on the US side for you to be considered a US resident. Of course, on the US side, we do have a substantial present test that you need to pass through before you're considered. The states are different. That test is for federal taxes only. The state are different. So depending on what state you move into, when you get your ID, when you get your apartment, when you really establish your residency within the state. So on the US side, it's a federal, where we have a test, and then we have a state which has its own rules. So Canadian residency is dependent upon the primary and the secondary ties, right? So again, if you are not sure, then fill out the NR73 form, send it to the CRA, and then let them make the determination for you, which is very important, right? We need the determination to be done, and we should know that you are a resident or not, because it matters. So this is how the Canadian residency is determined. If you're still tied to Canada, even though you have left and your family stayed back, of course, the CRA has the right to tax you on your worldwide income. That means, in some cases, majority of cases, additional taxes. Your US taxes are going to be lower. There are some exceptions to some states and cities where we have a lot more taxes, but those are exceptions. Majority of the time, that's not the case. All right, so now let's look at Canadian departure tax and then deemed disposition. So what happens on the US side is that, on the Canadian side, I'm sorry, on the Canadian side is that when you do become a non-resident, CRA will tax you on certain assets, even though you have not sold, right? So what it is that we call that a deemed disposition. So it's not actually selling, nothing has been realized or actualized, but it's happening on paper. So a deemed disposition is a tax event where an asset is sold at its fair market value, even though no actual sales has occurred. Deemed disposition calculates a capital gain on assets by calculating the difference between the fair market value and the cost. The capital gain generated through the deemed disposition is taxed by the CRA, which is known as the departure tax. This is what the deemed disposition is. So when you do leave Canada, there are certain assets that get deemed dispositioned, and then where the capital gains is triggered, and then there's tax on it. In some cases, there might be a loss. Of course, when there's a loss, the government doesn't want anything to do with it. When there's a gain, they want the tax. So deemed disposition is a paper realization. It's not an actual sale of assets, right? So this is what the deemed disposition is. And then so there are certain assets that where we have deemed disposition on the Canadian side. Now let's look into majority of the assets that you might own, before moving to the United States, or when you have moved to the United States. We're going to go through each assets, and we're going to talk about how the CRA is looking at it, if there's any U.S.-Canada tax treaty benefit that you can claim, and also if there's any planning opportunities, right? So I'm just going to quickly go through some of the main ones, and then for you to see, we'll be putting up this blog on our website, and then this video will be out there too for you to go through. So if you want to go into detail, you can go into detail. And then from, if you have any questions, again, shoot us an email, info@akifcpa.com, and we can gladly help you. All right, so understanding Canadian assets, right? RRSP is the biggest one out there. Of course, majority of Canadians will have RRSP even through their employer or by themselves. So RRSP is covered by U.S.-Canada tax treaty. There is no federal taxation on the RRSP when you do move, but there are states who do tax any income earned within that account. So there are states which we'll go through, and I'll list on some of the states that do not recognize U.S.-Canada tax treaty. So U.S.-Canada tax treaty is for federal purposes only. And then, so what are the planning that you can do before you're moving to the United States? Is that what you can do is you can crystallize, which is I'll tell you. I'm sorry, what happened here? Okay. All right. So you can crystallize. And what do I mean by crystallization? Crystallization is that you sell all your assets within RSP and buy back everything. So what you have done is you have accelerated your capital gains. You have, because it is a, after-tax account, meaning it's a pre-tax account. So, excuse me, anything that is happening in that account is not taxable until it comes out. So you can buy and sell. So what crystallization does is that it accelerates your capital gains in there. So if you bought something 10 years ago and now it's worth more than what you bought it for, you can sell it and buy it again at a new price. So what happens is that you have actualized all your gains with it, right? So when you move to the United States, all your value of that account, the RSP account, at that time when you move, becomes a cost on the US side, because there is no cost remaining, right? You have actuals. So that's one of the examples. So this is pre-planned moving. I mean that some people are able to do this, of course, if they are planning, and so for some people it's late. They're not able to do this. So that's another thing too. LIRA, next account is LIRA. So no tax consequences too. Again, this is a retirement account covered by the tax treaty. Same issues where again, the CR is not going to tax you on this. There's no deemed disposition. RSP, LIRA, both no deemed disposition. there is a U.S. Canada tax treaty which helps you differentiate tax on the U.S. side. The states are the exception. All right. RIF would be the same thing. RIF is, if you are withdrawing money, of course, the tax rate is 15%. I recently came across a client who was paying 25% on RIF. RIF is 15%. It's not 25%. The withholding on the RIF is 15%. It's not 25%. 25% is only when you withdraw RRSP account, and that's the maximum tax, again, according to the U.S. Canada tax treaty. So RPPs, the same thing, again, covered by the U.S. tax treaty, no disposition, no tax on the U.S. side, federally, state is the exception. So now let's talk about the states, which is the a great part. So again, certain states do not recognize treaties, and then so that means they will tax you on the earnings, any income in that account, which means any dividends, interest, capital gains that you might get in that account, right? So if you're getting those, that money in that account, the states are taxing you. So what does that mean? That means the U.S. is taxing you on that income. Canada is not doing it. And in the future, when you withdraw the money, you might have to pay tax at that time. So we're looking at a double tax scenario. I know the portion might be small, but this is getting into a double tax scenario. It's not additional tax. This is a double tax because you will end up paying tax on that on the Canadian side again, right? So some of the states that do not recognize tax treaty is Alabama, Arkansas, California, Connecticut, Georgia, Hawaii, Kansas, Kentucky, Maryland, Mississippi, Montana, New Jersey, North Dakota, and Pennsylvania. So in these states, the RSP income will be taxable. So you will have to report in the state any income that you earn in the RSP account. All right, so this is the exception. Let's go through the other accounts quickly. So FHSA, of course, no tax consequences when you leave Canada. This is not part of deemed disposition. You're not allowed to contribute after you do leave. Any withdrawal once you do leave after, let's say, for example, you have exited Canada, will be 25% withholding rate. Income earned in the FHSA is taxable in the U.S. Again, this is an account where we have no regulation on the U.S. side. So we will do reporting as we have other, just like we do for TFSA and other accounts, right? So TFSA, again, no tax consequences, no deemed disposition on the Canadian side. You're not allowed to contribute once you do move out, right? So once you move, no FHSA, no TFSA contributions. If you do contribute, once you have left Canada, there is a penalty. You have, in order to stop that penalty, you have to withdraw all the funds. I've seen cases where, some of my clients, in one case, there's a $15,000 penalty. In one case, we're still fighting the penalty. The penalty is about $10,000. So there are people who just don't understand, don't know the rules, and sometimes they miss all these rules, are still contributing because it is an after-tax account, right? The idea is that once you retire, you don't have to pay tax on this income once you take out, which is not true on the U.S. side. The U.S. sees this account as a taxable account. So number one recommendation will be to liquidate this account before you move. That will be the number one. If you have a lot more funds in there, you have investments, you look at the type of investment you might have, because we have PFIC rules. PFIC rules are that if you own Canadian mutual funds, Canadian ETFs in those accounts, those are considered PFIC, which is passive foreign investment companies. We do have reporting requirements, different reporting requirements on the U.S. side, which creates a lot of mess. That means understage taxation, more money going to the professionals. A lot of Canadians won't be able to fill this form out. It is just not possible. And I wouldn't recommend you filling this form by yourself either. There are huge penalties if you do miss this reporting. The penalties on the U.S. side are huge when it comes to foreign reporting. So make sure you find a professional that can really help you, right? So TFSAs are in the gray area. If you can, before you move, close those accounts. All right, so let's move on to the next one. RRSPs, again, no tax consequences, no deemed disposition. You cannot contribute once you leave. We do have a ruling on the IRS side, a procedure where the IRS does not consider this to be a trust. We do have income, but the income gets taxed. So, before the RSPs were considered a trust, now they are not. But with any income that you get in that account is taxable in the US. That's another thing. So if you, again, 25% tax withholding applies to withdrawal by non-resident beneficiaries. If you do withdraw the money after you have that. So RSP will be one of those accounts where we might be looking to close. Again, depending on the situation, how much money you put in, how old are the kids, how big is the account. There's so many things that you have to go through before deciding on this, right? So a lot of the stuff that we're discussing in this video, again, is general. If you want to be specific, email us, info@akifcpa.com, and we can help you. HBP and LLP, which is Home Buyers Plan and Lifelong Learning Plan. Both of these plans are considered money being borrowed from the RSP. Of course, once you do leave, or once you're planning to leave, money in these accounts must be paid back before you leave. So on your final return, any balances remaining in the HBP and LLP will be added back to your account if you haven't paid back. That means this is income to you when you leave Canada if you don't pay it back. So these accounts must be repaid before you leave. If you don't repay them, they will be added as an income to your T1 on the Canadian side. So make sure you do close them or you do pay them before you leave. This is very important because I feel that a lot of people miss this, and then people have quite a bit of balances remaining in those accounts, and then once you do leave, there's an additional tax. So you might feel like, hey, there's so much going on. Canada is stopping me from leaving Canada, but in real terms, I mean, if you really sit down, look at the things, you can plan, you can make it easy. It is overwhelming. I'll be honest with you, it's not easy. But at the same time, it's not impossible. You can do this. A planning is required. A good tax professional, a cross-border tax professional is required to help you with the planning. And then, make sure you can get this. You can get this done. A lot of people do it. I'm sure you can do it too. Canadian CPP and OAS, these are all, pension plans. Again, no tax consequences if you have them. If you're getting money, if you do go out, the good thing is that once you do leave, if you have OAS and CPP benefits coming to you, Canada cannot tax you anymore. Then everything gets taxed on the US side, which is great, because otherwise, you'll end up paying a lot more taxes on the Canadian side if you're leaving. So let's move on to non-registered investment accounts. Again, these are one of the accounts that CRA will tax you once you leave. So if you are a non-resident of Canada, technically you cannot operate this account by yourself. You need to be a resident of Canada for these accounts to be operated. So if you're leaving and you still have these accounts, there is a deemed disposition on these accounts. So that means Canada will tax you on any gains in this account. So make sure that you do liquidate or plan with your advisor to understand what is going to happen with your non-registered accounts, and make sure that you understand the tax consequences, right? I mean, it's important to really get this out of the way, because there will be a deemed disposition on the Canadian side, but that is not true on the US side. We do have tax relief benefits when it comes to this deemed disposition, but I feel like you can do planning to really minimize that, right? I mean, it's a lot of calculations to worry about, to keep track of when you are doing this. I will be, again, one way will be to liquidate, or one way will be to crystallize before you leave. Make sure that, if there's any deemed disposition, as it is small as possible. That's what I will do to make sure you utilize your losses if there's any in the same year. So I will be looking at this account more in detail. I will be talking to my financial advisor. I'll be talking to them too, and then understand how this is going to work if you do move out of Canada, because this account is subjected to deemed disposition. That means it doesn't matter if you're selling or not. On paper, it will be actualized. It will be realized where there will be capital gain or loss calculated on this. So that's the non-registered investment accounts. I want to get to some of the complicated stuff, which is the Canadian ESO, employee stock options, Canadian RSUs, restricted stock units, and then the shares of Canadian corporations. So these are a couple of the complex topics. I will go through them and in a summary really quickly, because this is case by case basis. Not everybody has them, and then so I've seen cases where we are stuck with a lot of taxation when it comes to people who have these, and then there's not much out there to understand what is happening with these accounts, or what happens when you leave Canada, and how these get taxed. So Canadian employee stock options, so no tax consequences if you are leaving, if you haven't, right? So and then so stock option exercise during non-residency will trigger Canadian source income. So that means again, this will be reported on T4, and then we'll be reporting on the tax return and the US return. So, excuse me, if you do exercise stock options, you will get a T4. And then let's say, for example, of course, if they're capital gains, once you do sell them, that's additional reporting, right? So make sure if you have Canadian employee stock options, talk to a professional before you leave. This is very important, because it's to understand how this is going to work. Employee stock options also matters, because if you're getting from a CCPC company, things are a little bit different. If you are getting from a non-CCPC company, these stock options, taxation will be different. So these are small details, but make a big impact on your taxes, right? So make sure you talk to Canadian employee stock options. It's complicated. Talk to professionals before you leave. Canadian restricted stock units, again, this is there's no deemed disposition on it, because they're still, for example, they were issued, but they were granted but not vested. And then so anything that gets vested, so RSUs are technically related to your services when you were working in Canada. So that means anything that was granted was based on the services that you provide to a Canadian company while living in Canada. Right, so what happens is when they get vested, there will be a trigger of reporting on the Canadian side, and then you will get a T4. This is important. You will get a T4 for the restricted option, restricted stock units when they get vested. And then if this company is on both sides of the border, this RSU vesting will also be reported on the US side. So in a sense, what is happening is that there is double tax withholding being done on the Canadian side and also on the US side. So the majority of the stuff is related to companies who are on both sides of the border. Some are big companies. So when you have Canadian RSUs, things are different for you, right? It all matters is when the services were provided, where were you? Where you're in Canada, where you're in the United States, and then of course this RSUs were granted to you. If they get vested, a lot of these RSUs are vested over 4 years. You're looking at if you left after 3 years or first year, and you still have 3 more years to go to get T4s. I mean, you have reporting requirements on the Canadian side and on the US side. So the share, again, Canadian ESO and Canadian RSUs are complicated. Not everybody has them. Make sure you talk to a professional. This is our recommendation, right? Shares of CCPC are subjected to deemed dispositions. That means whatever the value of the stocks, not the inventory, the value of the stocks is, CRA will tax you on it. Of course, we do have lifetime capital gain exemptions that you can use to reduce those capital gains. That of course will be limited based on the type of company that you have or how much gains you have, what the value is. This is also one of the complicated areas. Make sure you talk to a professional, understand how this is going to work. We did have a client last year who moved to a country in the East, and then end up owing a couple $100,000 to CRA, even after the lifetime capital gains exemption. And then so this was a shocking to him, right? And so again, plan, talk to a professional, talk to a cross-border professional who can help you understand this, because it is important. Now let's move on to So real property in Canada, that means any real estate, no tax consequences, no deemed disposition, but there is reporting requirements. If you do have, and this, let's say for example, if this is your primary home, I do want to take advantage of the principal residence exemption. On the Canadian side, if you're leaving, if you're putting on rent, I do want that to be reported. That's a lot of Canadians do miss that. Canadian tax professionals do miss that too. If you have a Canadian real estate that is on rent, it's a rental property, then of course we have other rules that kick in once you become a non-resident, which are the NR4 S216. This is something that is we can talk about in some other video. I've talked about this in other videos too. You can check out our blogs on NR4 S216. This is for reporting of your rental income. There's tax withholding on the rental income once you do become a non-resident of Canada. So Canadian real estate is not subject to deemed disposition. But if it's something other than Canadian, yes. Anything that is outside of Canada that you own in terms of real estate will be subject to deemed disposition. All right, so we've already covered those. Now let's get to one of the main places. I mean, so I'm going to look at the chart. This is, we'll be putting. This should be on our website. You can find out about this. So this is a Canadian chart. This is the chart of Canadian assets reflecting Canadian and U.S. tax consequences upon leaving Canada. All right. I'm talking about a simplified form for you guys where you can see how things will be on the Canadian side, how the U.S. side is going to tax you, and then if there's any withholding, and then what are tax planning opportunities. So quickly, this is one of the things that we've worked on. Again, trying to help out fellow Canadians who are moving to the United States, help them with tax planning, help them to simplify taxes, to report and simplify reporting, and then to make this manageable, right? And this is overwhelming. I cannot stress this enough. This is the first year it gets overwhelming. It becomes stressful. You don't want, if you cannot do this on your own, don't do it. If you miss reporting, there are huge penalties. Understand what needs to be reported. Make sure you do understand what needs to be reported, because I've seen a lot of cases. So Canadians are DIY people, right? I mean, they want to do it, themselves. And I get that on the forms, instructions from the CRA are easier to understand. But that is not true on the US side. Forms are complex, instructions are complex. And then not many people can really help you. That's the truth. So make sure, you get some professional. If you cannot do this on your own, first year will be complex. Once you get through the first year, things will get easier. Plan, and that's the whole point here, right? So, and that's the reason we are doing this. So I want to make sure that you get enough information to simplify your reporting, to be able to understand, and then make better moves. That's the idea. Making better moves where you can help yourself. I don't want you to be stuck in a position where you're continuously relying on a cross-border professional to help you. There are not that many out there. And then if you get stuck, it is a problem. The fees, the professional fees are huge. On top of that, we have additional taxation, additional reporting. I don't want that mess. I want things to be simple for me. And then, so if I want things simple for me, I want the same for you. Keep cross-border tax simple and manageable. This will be my number one advice. So let's go through the chart. So Canadian RRSPs, again, no tax consequences, not allowed to contribute after you leave. There is, of course, U.S. taxes. We're talking about, we're talking about the federal level. There's no issue because of the U.S. Canada treaty, but some states do not recognize tax treaties, and then so their income that's going to be taxed in those states. Are you required to close this account? No. I mean, if you are going to keep it, keep it. If you do take out money and before it becomes a RIF, then of course there's a 25% tax according to U.S. Canada tax treaty that you have to pay on the lump sum. So tax planning opportunity. Before you leave, maximize. Put as much as you can based on your income that year. I don't want you to just say, hey, I have 100,000, I'm going to put 100,000. Don't do that. Put what you need. That means put what you need according to your income that year. All right. And then make sure that you maximize that account before you leave. just Canada Tax Treaty, not required to close. Of course, you cannot close. It's a locked-in account. You can unlock it after 2 years. Once you have become a non-resident for 2 years, you have to be a non-resident. And then, of course, you can take the money out. Again, tax planning is, 2 years unlocked after being a non-resident of Canada. So let's move to these retirement accounts. The same thing again. Same issues. I'm not going to touch on them. They're all covered. TFSA again, it's a gray area account. Gray. This is TFSA. It's a gray area. No tax consequences, but that doesn't mean nothing really happens on the U.S. side. TFIC rules. Everything gets taxed. Everything needs to be reported. If I can, I will close this account. And then, so this is what I would do. You're not required to close, but we will recommend closing it. Tax planning, again, same thing we're saying. Make sure you do close it. So FHSA I've already covered. FHSA is again, this is no tax consequences. Investment income is taxable in the U.S. You're not required to close. Again, if you do withdraw the money, 25% withholding, we will recommend closing this account. RRSP, no tax consequences on the Canadian side. If you do move, investments in investment income and government contribution are taxable in the U.S. You're not required to close. If the amount is small, just close them. If you 25% tax on withdrawal, return of the government grant if the beneficiary is a non-resident. So these are things that you have to look out for. Planning is available. Consult a tax professional advisor. So HBP and LLP, you have to pay this money back once you move from Canada. Of course, the accounts get closed once you move, so there is no tax consequence on the U.S. side. You are required to close these accounts. Again, 000. Canadian pension plan, OAS. Make sure you update the CRA that you're no longer there. So, no tax withholding if you are moving to U.S. Everything gets taxed in the U.S. Nothing on the Canadian side. Non-insured account, yes, there is dim disposition. Again, I've covered this in detail, what really means. Income is taxable on the U.S. side. Short-term, long-term capital gain rates apply. So we do have different rates on the U.S. side on short-term and long-term. We will recommend closing this account. I would say before you move, close this account if you can. Again, Canadian ESO, RSUs, complicated areas. Talk to a professional. Once you have them, make sure you understand how the rules are going to work. Even if you move, if you have ESO and RSUs, and then things get vested or you exercise your stock options, then there will be a T4. That means Canadian reporting will be required. Things will be reported on the U.S. side too, and then there might be double withholding. So again, talk to a tax professional to help you with the ESUs, RSU, and then the shares of the corporation too, right? Make sure this is all planned. Primary residence, no tax. You can get the advantage of the capital gain exemption for your primary home. I will make sure I do that, on the final return. If you're converting this into a rental property, then again, non-resident rental rules apply, which means tax withholding on the rental income. That's true on the rental property too. There is no deemed disposition on the Canadian real estate. That means any real estate that you own on the Canadian side or in Canadian soil is not subject to deemed disposition. But if you own real estate outside of Canada, those are all subjected to deemed disposition. If you do sell these properties after you have moved, we have other rules that kick in. Talk to a professional because there's timing issues. Certain forms need to be filed within a certain time. CRA is going to withhold your money. This needs to be planned out. This is what I'm getting to, because I want this to be limited. I've seen cases where somebody will sell a house, let's say, for example, in January. Nowadays, with the CRA and the way things are, it takes about the whole process. By the time you sell your house and you get your money back, it's like 12 months. In some cases, 11 months. In some cases, even longer. So, and then again, I will try to shorten that time. And how can you shorten that time? By planning. Make sure you understand what are real times happening on the CRA side. How long is they're taking to process the T2201 forms. These are capital gains form for a non-resident selling a Canadian property. All right, so these are the these are the things that I wanted to go on with you, and then so the real estate is only limited to the Canadian side. Non-Canadian properties again are subjected to deemed disposition. If I have not covered anything on these lists, make sure you send us an email, info@akifcpa.com, and then we'll gladly help you. Of course, this is all general. If you have specific tax situation and you want to talk to us, send us an email too. I will be gladly get on call, do a consultation too, and then really plan with you, help you simplify this. So there will be a tax checklist that will be put up on our website that you can download for Canadians who are moving to US, for you to go through some, majority of the items that you should be looking at, you should be working on while when you move or you have moved. Look at things where you should have worked on if you've already moved. And then any other questions, again, email us info@akifcpa.com, and we'll help you. Thank you very much. Bye-bye.